In 2025, global economic growth is projected to fall to just 2.3%, below the 2.5% threshold typically associated with a global recession. What if artificial intelligence becomes the final domino that triggers a catastrophic economic chain reaction? I've spent the last 6 months analyzing how AI adoption could spark an economic collapse. The numbers are alarming. 57 million European jobs at risk, critical supply chains vulnerable to disruption, and a technological revolution outpacing our economic systems. Like a tsunami gathering force offshore, this AI-driven transformation threatens to overwhelm unprepared economies, potentially reshaping entire industries before regulatory frameworks can adjust. The economic precipice. Imagine a single domino falling and an entire economic system collapsing in its wake. Not a dramatic fiction, but a scenario economists now consider possible as global growth slows toward a critical threshold. The United Nations Conference on Trade and Development has published their Trade and Development Foresights report, and the projections paint a concerning picture. Global economic growth is expected to decelerate to just 2.3% in 2025, falling below the 2.5% threshold that typically defines a global recession. This moment is uniquely precarious due to the simultaneous acceleration of artificial intelligence adoption across major economies. AI is experiencing exponential improvement in capabilities while implementation costs decrease. Companies are integrating these technologies at unprecedented speed compared to previous technological transitions. The UNCTAD report reveals a stark contrast to pre-pandemic performance. Before COVID-19, global economic growth consistently averaged around 3.5% annually. The post-pandemic recovery briefly pushed growth rates higher, but this momentum has faded, leaving us sliding toward the recession danger zone. This projected slowdown creates the perfect conditions for a cascade of economic consequences, like a row of dominoes where each falling piece knocks down something larger than itself. When growth slows to these levels, businesses become hesitant to invest in expansion. Without investment, job creation stagnates. As employment opportunities diminish, consumer spending, the force driving approximately 70% of economic activity in developed nations, begins to contract. This contraction further suppresses business revenue, triggering additional job losses. Each element amplifies the impact of the others, potentially creating a downward spiral that gains momentum with each falling economic domino. The introduction of widespread AI implementation into this vulnerable system magnifies the risk substantially. Companies facing economic pressure naturally seek cost-cutting measures. Advanced AI systems capable of performing knowledge work present an attractive option for businesses trying to maintain profitability during slowdowns. This accelerates job displacement precisely when the economy lacks the strength to create new opportunities. The timing aligns dangerously with AI capabilities reaching inflection points across multiple domains simultaneously. Language processing, image generation, data analysis, and decision-making systems are all experiencing rapid improvements. Software that can write marketing copy, analyze legal documents, generate code, and perform customer service functions is becoming increasingly capable and affordable. Evidence of this shift is already visible. Major financial institutions have reduced their analyst workforces as AI systems demonstrate comparable performance in data processing. Customer service operations across industries have integrated AI chatbots that handle increasingly complex inquiries. Content creation, from marketing materials to basic news articles, now frequently involves AI assistance or automation. These implementations haven't triggered mass unemployment yet because they've occurred during periods of economic expansion when new opportunities emerged for displaced workers. The situation changes dramatically when this acceleration continues during an economic slowdown, as the growth buffer that previously absorbed technological disruption disappears. The vulnerability extends beyond employment concerns. Our financial systems have developed significant interdependencies, creating potential contagion paths where distress in one sector quickly transmits to others. The 2008 global financial crisis demonstrated how rapidly problems can propagate through these connections, and our systems have grown more interlinked since then. Several structural weaknesses compound this vulnerability. The European Union faces demographic challenges with aging populations and declining birth rates. China continues to struggle with real estate market corrections. The United States confronts persistent inequality that concentrates economic gain among top earners who tend to save rather than spend throughout the economy. These factors create subdued demand across major economies precisely when robust consumption is needed most. Financial conditions add another layer of instability. Central banks worldwide have maintained higher interest rates to combat inflation, increasing borrowing costs and straining companies that expanded during the previous low-interest period. This echoes historical patterns seen in the early 1980s recession, when rapid interest rate increases designed to combat inflation contributed to significant economic contraction and job losses. The key question becomes whether our economic systems can adapt quickly enough to this converging set of challenges. Historical technological transitions occurred over decades, allowing labor markets time to adjust gradually. The manufacturing automation wave of the 1970s to 1990s unfolded over 20 years, giving workers and institutions time to adapt. The AI revolution appears to be unfolding much more rapidly, potentially outpacing our institutional capacity for adaptation. Companies will face increasing pressure to maintain profitability during the projected slowdown. AI implementation offers an appealing solution to cut costs quickly. The resulting job displacement occurs when the economy lacks the dynamism to create new opportunities. Consumer spending falls as unemployment rises, further suppressing economic activity. Policy responses that might mitigate these effects typically require years to implement effectively. If AI adoption accelerates while growth decelerates, we may not have that time. What makes this scenario particularly concerning is that it doesn't require a sudden shock to initiate. The gradual slowing of growth combined with steady AI improvement could erode economic resilience needed to absorb technological displacement. None of this means economic collapse is inevitable. History shows that technological transitions, while disruptive, eventually create new forms of value and employment. The Industrial Revolution initially displaced craftspeople, but ultimately generated unprecedented prosperity. The challenge is navigating the short-term disruption without triggering a self-reinforcing recession. Economic systems depend significantly on confidence and expectations. If businesses and consumers become convinced that an AI-triggered downturn is imminent, their cautious behavior can manifest the very recession they fear. But to understand how AI could be the tipping point that pushes a vulnerable economy into recession, we need to examine the workforce revolution already underway. AI's job displacement wave. What happens when millions of jobs disappear not over decades, but in just a few years? Previous technological revolutions spread their impact across generations. The mechanization of agriculture took nearly a century. The shift from manufacturing to services played out over decades. But artificial intelligence threatens to compress this timeline dramatically, potentially displacing tens of millions of workers before economic systems can adapt. AI systems today automate both routine tasks and complex cognitive work previously thought to require human intelligence and creativity. This represents a fundamental shift in the relationship between technology and human labor. Take Ants Telecom, which implemented an AI customer service system in 2021. Within 18 months, they reduced staff by 35% while customer satisfaction scores increased by 12%. We expected efficiency gains, says their operations director, but we didn't anticipate how quickly the AI would improve at handling complex customer problems. According to research from a European Commission's Joint Research Center, approximately 57 million jobs across the European Union face potential displacement through AI automation in the coming years. How will economies absorb this shock? This represents roughly 25% of the entire European workforce, with most impacts potentially occurring within a 5 to 7 year window once implementation reaches critical mass. What makes this wave of automation different is its target. Previous automation primarily affected blue-collar manufacturing and low-skilled service work. The current wave threatens knowledge workers, professionals, and creative occupations. Customer service represents one of the most vulnerable sectors. AI-powered chatbots and voice assistants now manage complex customer interactions. Major telecommunications companies report their advanced AI systems successfully resolve up to 70% of customer inquiries without human intervention. These systems continuously improve by analyzing thousands of past interactions, handling increasingly nuanced scenarios. Data analysis positions face similar pressure. AI systems excel at identifying patterns in large datasets, generating insights, and creating visualizations. Financial institutions have been early adopters, with several major European banks reducing their analytics departments by 20 to 30% after implementing AI systems. These systems process quarterly reports, market trends, and competitive analysis faster and with fewer errors than human teams. Content creation represents a surprising area of disruption. AI writing systems now produce marketing materials, basic news articles, product descriptions, and creative content at a fraction of human costs. A major European media conglomerate uses AI to generate approximately 40% of its online content, with human editors providing oversight. Similar tools are transforming graphic design, video editing, and audio production. Administrative roles face perhaps the most immediate threat. Functions like scheduling, documentation, expense processing, and basic correspondence now frequently run through AI systems. Many organizations have reduced administrative staff by 40 to 50%, with remaining staff focusing on complex coordination tasks. Some sectors remain relatively protected. Agriculture still requires significant human judgment for crop management and adaptation to environmental conditions. Logistics presents a mixed picture. While planning increasingly uses AI, the physical tasks of loading and delivering goods still exceed AI capabilities in many contexts. Teaching remains relatively stable, particularly for younger students, though teachers increasingly use AI tools for lesson planning and personalized learning recommendations. We're seeing real examples of AI systems performing complex expert work. Legal AI systems now review contracts and suggest alternative language, work traditionally performed by junior lawyers. Major law firms report completing document review in a fraction of the time previously required. Similarly, AI medical diagnostic systems analyze images with accuracy matching or exceeding specialized radiologists. One system deployed across several European hospitals detects certain lung abnormalities with 94% accuracy, compared to the human average of 88%. The projected timeline shows concerning acceleration. Most analysts predict 2025 to 2030 will see the most dramatic workforce impacts. The first wave, already beginning, primarily affects data processing roles. By 2026 to 2027, creative and professional services expect significant disruption. By 2028 to 2030, even specialized knowledge fields may face substantial AI competition. This raises a critical question. How quickly can displaced workers transition to new roles? Historical evidence suggests transitions require significant time. After manufacturing automation, many displaced workers never return to equivalent employment. Retraining programs show mixed success, with completion rates averaging 60 to 70% and successful transitions taking 18 to 36 months even with support. If AI displaces millions of European workers annually by 2026, but each worker requires 2 to 3 years for successful transition, we face a growing population without clear economic opportunities. Worker retraining also faces the moving target problem, training for roles that might be automated by completion time. Over the next 5 years, knowledge work faces unprecedented disruption. Financial services may lose 30 to 40% of current positions. Administrative support across all sectors could see 40 to 50% reductions. Marketing and content creation fields project 25 to 35% displacement, while customer service expects 35 to 45% reductions. These knowledge work positions historically served as landing spots for workers displaced from other sectors. As these positions become automated, where will displaced workers go? The economic implications extend beyond individual job losses. Consumer spending drives approximately 70% of economic activity in developed economies. Widespread job displacement threatens this essential economic engine. Additionally, tax revenue depends heavily on employment income, creating fiscal challenges precisely when social supports need expansion. Throughout history, technological changes have ultimately created more jobs than they eliminated. However, The compressed timeline of AI displacement creates unprecedented challenges. The potential benefits remain significant, but harvesting these while managing transition challenges requires deliberate policy approaches. Job displacement isn't evenly distributed. Some regions face a perfect storm of technological and demographic challenges that magnify their vulnerability, particularly in Eastern and Southern European economies. The East-West vulnerability divide. Why are Eastern and Southern European economies standing on the most fragile economic ground in the face of AI disruption? The answer lies in a dangerous confluence of technological and demographic factors that create unique vulnerabilities for these regions. A comprehensive policy brief from Bruegel, the Brussels-based economic think tank, highlights a stark demographic divide emerging across the European Union. While much attention focuses on technology's impact on employment, these demographic shifts may actually determine which regions can successfully navigate the AI transition and which might face economic collapse. The demographic data presents a troubling picture for Eastern and Southern Europe. Several countries face projected population declines exceeding 20% by 2050, with Bulgaria potentially dropping from 6.9 million to below 5.4 million people, and Greece falling from 10.4 million to approximately 8.9 million. These transformative changes reshape entire economic structures. Our town had 15,000 people when I was growing up. Today, barely 9,000 remain, mostly elderly. Young people leave for Germany or France as soon as they finish school, explains Miroslav, a small business owner in rural Bulgaria. His experience illustrates the human reality behind the statistics. Two primary factors drive these demographic shifts in combination. Fertility rates well below replacement level, 1.3 to 1.6 births per woman compared to the 2.1 needed for stability, and significant outward migration of younger, working-age citizens. This creates a demographic double blow that depletes human capital precisely when adaptation to technological change demands it most. Western and Northern European economies, resembling robust reservoirs that retain their resources, benefit from immigration that partially offsets lower birth rates. France's population may grow by 5.1% through 2050, while the Netherlands projects 7.3% growth. Meanwhile, Eastern economies function like leaky buckets, continuously losing their most valuable resource, working-age citizens, to wealthier neighbors. As populations shrink, workforce contractions follow. Bulgaria's working-age population could decline by 33% by 2050, with Romania facing a 30% reduction. Just as these populations contract, AI advances, intensifying a regional vulnerability gap that strains everything from pension systems to labor markets. Tax bases inevitably contract alongside population declines. With fewer taxpayers, countries face difficult choices. Increase tax rates on remaining workers, potentially accelerating immigration, cut public services, or accumulate unsustainable debt. Domestic markets also contract, creating particular challenges for local businesses that depend on local population density and purchasing power. When AI adoption patterns overlay this demographic landscape, the potential for economic divergence intensifies. Research suggests Northern and Western European countries will implement AI 30 to 40% faster than Southern and Eastern regions. This creates a technological acceleration gap where demographically healthier regions also benefit from earlier productivity gains. Countries with aging populations face particular difficulties adapting to rapid technological change. Educational systems must evolve quickly, but this adaptation requires resources and institutional flexibility that declining regions increasingly lack. We know AI will transform our factory operations, notes Helena, a manufacturing supervisor in Romania. But finding engineers who understand these systems is nearly impossible. They've all moved to Germany. The demographic and technological divisions create a self-reinforcing cycle. As Western European economies implement AI more rapidly, their productivity advantages increase, widening wage differentials with Eastern regions and potentially accelerating westward migration. This further depletes human capital in Eastern regions, making them less attractive for AI-related investment. Specific sector vulnerabilities compound these challenges. Healthcare systems face particular pressure as populations age while healthcare workforces shrink. Bulgaria already faces a shortage of approximately 30,000 nurses, projected to widen to 40,000 by 2030. Infrastructure maintenance becomes more difficult with contracting labor forces, potentially leading to deteriorating physical infrastructure alongside digital transformation. Financial institutions across Eastern Europe already struggle with talent acquisition for digital transformation. As AI accelerates change in financial services, institutions in demographically challenged regions may fall further behind, creating competitive disadvantages and potential financial system vulnerabilities. These combined pressures raise concerns about economic fracturing within the European Union. Growth rate divergence between regions could intensify beyond levels manageable within existing EU frameworks, with projections showing potential annual growth differentials of 1.5 to 2.5 percentage points between the strongest and weakest regional economies. Pension systems face particular stress, with countries like Poland, Hungary, and Romania projecting old age dependency ratios increasing from around 30% to exceeding 50% by 2050. This means fewer than 2 working-age adults for each retirement-age citizen, creating unsustainable pressure on social security systems. What emerges is a clear picture of heightened vulnerability in Eastern and Southern EU countries due to demographic collapse coinciding with technological disruption. While Western and Northern European economies have challenges managing AI transition, they benefit from more stable demographics and stronger starting positions in technological implementation. This regional divergence creates concerns beyond Europe's borders. Eastern European countries have become integrated into global supply chains, particularly in manufacturing. Disruption in these regional economies could cascade through production networks, affecting global manufacturing. Financial instability could similarly transmit through increasingly connected capital markets. These regional vulnerabilities extend beyond Europe's borders into a complex web of global trade relationships. As we'll see next, the current trade tensions between major economies create another accelerant that could turn technological disruption into economic catastrophe. The trade war accelerant. How could escalating trade tensions turn technological disruption into economic catastrophe? Consider this. The United States' average effective tariff rate has reached 23%, a level not seen since 1909. This remarkable reversion to early 20th century protectionism isn't happening in isolation. It's occurring precisely as artificial intelligence begins fundamentally reshaping global supply chains and manufacturing capabilities. This combination creates a potentially dangerous accelerant effect. Trade tensions increase costs and create uncertainty throughout global commerce. AI simultaneously enables rapid production shifts that could destabilize existing economic relationships. Together, they transform manageable economic disruption into something far more severe. The U.S.-China trade relationship illustrates this precarious situation. Last year, these two economic superpowers exchanged approximately $585 billion in goods, with the United States maintaining a $295 billion deficit. This trade imbalance has become politically charged, driving policies that attempt to reduce American dependency on Chinese manufacturing. AI threatens traditional manufacturing equilibrium in several important ways. First, it reduces the labor cost advantage that drove outsourcing originally. Advanced manufacturing increasingly relies on robotics and automation rather than large human workforces. When production becomes highly automated, labor costs represent a smaller percentage of total expenses, diminishing the incentive for locating production in lower-wage regions. Companies like Tesla demonstrate this shift clearly. Their newest manufacturing facilities use AI-powered robotics, requiring minimal human intervention. Location decisions for these facilities increasingly depend on factors beyond labor costs: proximity to markets, technical expertise availability, and supportive regulatory environments. This enables reshoring of previously outsourced manufacturing, particularly for products with complex logistics or intellectual property concerns. The Boston Consulting Group estimates that approximately 20 to 25% of goods currently manufactured in China for American markets could economically relocate to the United States within 5 years as AI and automation advance. This percentage increases to nearly 35% when factoring in current tariff rates. Such a significant shift would fundamentally alter trade patterns established over decades. Reshoring opportunities don't distribute evenly across industries. Electronics assembly, precision components, and advanced materials show the greatest potential for automation-enabled reshoring. Textiles, basic consumer goods, and raw material processing remain more likely to stay in regions with lower costs. This creates uneven disruption across manufacturing sectors. Trade tensions have already shifted production patterns independently of AI developments. Mexico has emerged as a primary beneficiary, with its exports to the United States increasing by 25% since tariff escalation began. Vietnamese manufacturing has similarly expanded, with exports to the U.S. growing 41% during the same period. These shifts occurred primarily through traditional offshoring decisions rather than automation-driven transformations. When AI acceleration combines with these existing trade diversification trends, the pace of change could exceed the adaptive capacity of affected regions. Chinese manufacturing hubs that lose production to both reshoring and diversification could experience rapid employment contractions. Automotive component manufacturing in Jiangsu province has already seen a 15% reduction in employment over 2 years as production shifts to Mexico and automated facilities in the United States. The economic impacts extend beyond manufacturing locations. Global logistics networks developed around specific trade patterns over decades. Shipping companies invested in vessels based on projected trade volumes. Commercial real estate development in manufacturing regions assumed continuing. Industrial growth. Financial institutions structured lending portfolios around expected regional economic trajectories. Rapid shifts disrupt these interconnected systems simultaneously. AI adoption accelerates these production shifts by enabling faster factory reconfiguration. Traditional manufacturing relocations required extensive planning. Modern AI-integrated production systems can reconfigure more quickly, with some facilities capable of switching product lines in weeks rather than months. This technological flexibility makes production shifts more responsive to trade policy changes. Consequently, new economic winners and losers emerge rapidly. Countries positioned to benefit from both trade diversion and AI implementation experience manufacturing booms. Mexico appears particularly well-positioned, with proximity to the U.S. market, established manufacturing expertise, and increasingly sophisticated technical capabilities. Eastern European nations like Poland and the Czech Republic similarly stand to gain from production moving out of Asia while remaining close to European markets. Countries heavily dependent on export manufacturing but lacking technical infrastructure for AI implementation face the greatest risks. Malaysia, Thailand, and parts of coastal China have economies structured around their position in global supply chains. As these chains reconfigure, these regions could experience economic contractions with limited alternative growth sectors immediately available. The destabilization of existing economic relationships creates additional risks. Trade relationships create interdependencies that stabilize international relations despite political differences. As production networks reconfigure, these economic bonds may weaken, potentially reducing incentives for diplomatic cooperation during periods of tension. This creates a feedback loop where economic decoupling and political tension reinforce each other. Currency markets represent another vulnerability. Countries experiencing sudden manufacturing contractions often face currency depreciation as economic prospects dim. This depreciation can trigger capital flight, creating financial instability that compounds economic challenges. When multiple export-dependent economies experience simultaneous pressure, contagion effects become possible. With U.S. tariff rates at 23%, nearly 4 times their level before recent trade tensions, the economic friction in global commerce has increased substantially. These elevated tariffs function as a tax on supply chains, increasing costs throughout production networks. When combined with AI-driven restructuring, they create uncertainty that typically leads businesses to delay investments and reduce hiring. The potential economic consequences extend beyond manufacturing sectors. Consumer prices increase as tariffs and supply chain restructuring raise production costs. Business investment declines amid uncertainty about future trade conditions. Financial markets must reprice assets across regions, experiencing rapid economic transitions. Each effect contributes to recessionary pressure in an already vulnerable global economy. Will current trade tensions and AI acceleration melt away established supply chains? How could escalating trade tensions turn technological disruption into economic catastrophe? Consider this. The United States' average effective tariff rate has reached 23%, a level not seen since 1909. This remarkable reversion to early 20th century protectionism isn't happening in isolation. It's occurring precisely as artificial intelligence begins fundamentally reshaping global supply chains and manufacturing capabilities. This combination creates a potentially dangerous accelerant effect. Trade tensions increase costs and create uncertainty throughout global commerce. AI simultaneously enables rapid production shifts that could destabilize existing economic relationships. Together, they transform manageable economic disruption into something far more severe. The U.S.-China trade relationship illustrates this precarious situation. Last year, these two economic superpowers exchanged approximately $585 billion in goods, with the United States maintaining a $295 billion deficit. This trade imbalance has become politically charged, driving policies that attempt to reduce American dependency on Chinese manufacturing. AI threatens traditional manufacturing equilibrium in several important ways. First, it reduces the labor cost advantage that drove outsourcing originally. Advanced manufacturing increasingly relies on robotics and automation rather than large human workforces. When production becomes highly automated, labor costs represent a smaller percentage of total expenses, diminishing the incentive for locating production in lower-wage regions. Companies like Tesla demonstrate this shift clearly. Their newest manufacturing facilities use AI-powered robotics, requiring minimal human intervention. Location decisions for these facilities increasingly depend on factors beyond labor costs: proximity to markets, technical expertise availability, and supportive regulatory environments. This enables reshoring of previously outsourced manufacturing, particularly for products with complex logistics or intellectual property concerns. The Boston Consulting Group estimates that approximately 20 to 25% of goods currently manufactured in China for American markets could economically relocate to the United States within 5 years as AI and automation advance. This percentage increases to nearly 35% when factoring in current tariff rates. Such a significant shift would fundamentally alter trade patterns established over decades. Reshoring opportunities don't distribute evenly across industries. Electronics assembly, precision components, and advanced materials show the greatest potential for automation-enabled reshoring. Textiles, basic consumer goods, and raw material processing remain more likely to stay in regions with lower costs. This creates uneven disruption across manufacturing sectors. Trade tensions have already shifted production patterns independently of AI developments. Mexico has emerged as a primary beneficiary, with its exports to the United States increasing by 25% since tariff escalation began. Vietnamese manufacturing has similarly expanded, with exports to the U.S. growing 41% during the same period. These shifts occurred primarily through traditional offshoring decisions rather than automation-driven transformations. When AI acceleration combines with these existing trade diversification trends, the pace of change could exceed the adaptive capacity of affected regions. Chinese manufacturing hubs that lose production to both reshoring and diversification could experience rapid employment contractions. Automotive component manufacturing in Jiangsu province has already seen a 15% reduction in employment over 2 years as production shifts to Mexico and automated facilities in the United States. The economic impacts extend beyond manufacturing locations. Global logistics networks developed around specific trade patterns over decades. Shipping companies invested in vessels based on projected trade volumes. Commercial real estate development in manufacturing regions assumed continuing industrial growth. Financial institutions structured lending portfolios around expected regional economic trajectories. Rapid shifts disrupt these interconnected systems simultaneously. AI adoption accelerates these production shifts by enabling faster factory reconfiguration. Traditional manufacturing relocations required extensive planning. Modern AI-integrated production systems can reconfigure more quickly, with some facilities capable of switching product lines in weeks rather than months. This technological flexibility makes production shifts more responsive to trade policy changes. Consequently, new economic winners and losers emerge rapidly. Countries positioned to benefit from both trade diversion and AI implementation experience manufacturing booms. Mexico appears particularly well positioned, with proximity to the U.S. market, established manufacturing expertise, and increasingly sophisticated technical capabilities. Eastern European nations like Poland and the Czech Republic similarly stand to gain from production moving out of Asia while remaining close to European markets. Countries heavily dependent on export manufacturing but lacking technical infrastructure for AI implementation face the greatest risks. Malaysia, Thailand, and parts of coastal China have economies structured around their position in global supply chains. As these chains reconfigure, these regions could experience economic contractions with limited alternative growth sectors immediately available. The destabilization of existing economic relationships creates additional risks. Trade relationships create interdependencies that stabilize international relations despite political differences. As production networks reconfigure, these economic bonds may weaken, potentially reducing incentives for diplomatic cooperation during periods of tension. This creates a feedback loop where economic decoupling and political tension reinforce each other. Currency markets represent another vulnerability. Countries experiencing sudden manufacturing contractions often face currency depreciation as economic prospects dim. This depreciation can trigger capital flight, creating financial instability that compounds economic challenges. When multiple export-dependent economies experience simultaneous pressure, contagion effects become possible. With U.S. tariff rates at 23%, nearly 4 times their level before recent trade tensions, the economic friction in global commerce has increased substantially. These elevated tariffs function as a tax on supply chains, increasing costs throughout production networks. When combined with AI-driven restructuring, they create uncertainty that typically leads businesses to delay investments and reduce hiring. The potential economic consequences extend beyond manufacturing sectors. Consumer prices increase as tariffs and supply chain restructuring raise production costs. Business investment declines amid uncertainty about future trade conditions. Financial markets must reprice assets across regions experiencing rapid economic transitions. Each effect contributes to recessionary pressure in an already vulnerable global economy. Will current trade tensions and AI acceleration melt away established supply chains faster than economies can adapt? The semiconductor vulnerability. What happens when the very chips powering AI become the weak link in the global economy? While we focus on AI's implications for jobs and economic systems, we often overlook a critical vulnerability: the physical infrastructure making these advances possible. Advanced semiconductor production represents one of the most concentrated industrial capabilities in the global economy. The manufacturing of cutting-edge semiconductors, the chips that enable AI processing, is limited to just 3 companies worldwide: Taiwan's Semiconductor Manufacturing Company, TSMC, Samsung in South Korea, and Intel in the United States. TSMC dominates production of the most advanced chips, manufacturing approximately 90% of the world's most sophisticated semiconductors. This concentration creates a significant single point of failure in the global technology ecosystem. Geographically, this production is even more concentrated. Over 60% of advanced semiconductor manufacturing occurs within a 100-mile radius in East Asia, primarily across Taiwan and South Korea. Taiwan alone produces 37% of all new computing chips globally and 92% of the most advanced chips. This geographic clustering developed for valid economic reasons. Semiconductor manufacturing requires specialized expertise, established supply networks, and economies of scale that naturally lead to regional specialization. Just as trade routes and demographic patterns set the stage for economic vulnerability, semiconductors represent the final, fragile link in the chain. These tiny silicon components function as the nervous system of a modern economy, transmitting signals that coordinate everything from financial markets to manufacturing lines. When semiconductors primarily powered consumer electronics and traditional computing, this concentration was manageable. However, as AI development accelerates, these chips have transformed from important components into critical infrastructure underpinning economic transformation. The demand for advanced semiconductors is experiencing unprecedented growth driven by AI development. NVIDIA, the leading producer of graphics processing units, GPUs, used for AI, has seen demand exceed supply for over 2 years. Their data center revenue, primarily driven by AI applications, increased 141% year-over-year, according to recent financial reports. Despite significant production increases, wait times for advanced AI chips still extend to 6 to 9 months for many models. This demand surge has triggered massive investment in new manufacturing capacity. TSMC has committed $100 billion for expansion over 3 years. Samsung announced $116 billion in semiconductor investments by 2030. Intel plans $20 billion for new factories in the United States. However, construction for new semiconductor facilities typically requires 3 to 5 years before reaching full production, creating a prolonged period where demand continues to outpace supply. The vulnerability becomes apparent when considering potential disruptions to this concentrated manufacturing base. Industry analysts estimate that a 3-month disruption to Taiwanese semiconductor production would affect approximately 70% of global electronics production. The impact would cascade through multiple sectors simultaneously, from automotive manufacturing to medical devices to telecommunications infrastructure. We've already witnessed the economic impact of semiconductor shortages. During the COVID-19 pandemic, disruptions to chip manufacturing combined with increased demand created widespread shortages. The automotive sector alone lost an estimated $210 billion in revenue during 2021 due to production delays. Manufacturers including Ford, General Motors, and Toyota were forced to temporarily shut down multiple assembly plants, with some facilities idle for months. Similar constraints affected everything from gaming consoles to household appliances. The economic consequences of a more significant disruption would be substantially greater. Goldman Sachs estimates that a prolonged semiconductor shortage affecting advanced chip production could reduce global GDP by up to 0.7% within 6 months. AI development faces particular vulnerability to semiconductor disruption. Training advanced AI models requires enormous computing resources. OpenAI's GPT-4 reportedly required over 25,000 specialized GPUs for training. Any significant disruption to the supply of these processors would immediately slow AI advancement across both research and commercial applications. Companies have recognized this vulnerability and attempted to create resilience through inventory management. Major technology firms have increased semiconductor stockpiling, maintaining several months of critical components. Governments have also recognized the strategic importance of semiconductor manufacturing. The United States passed the CHIPS Act, providing $52 billion in subsidies for domestic semiconductor production. The European Union has announced similar initiatives. However, these efforts will take years to significantly diversify production. The vulnerability extends beyond physical production to the complex supply chains supporting semiconductor manufacturing. Advanced chip production requires specialized materials and components from dozens of countries. Disruption at any point in this supply network can impact production even if core manufacturing facilities remain operational. A major disruption affecting East Asian semiconductor production would impact both AI development and broader economic stability simultaneously. As AI increasingly integrates into critical economic functions, the dependency becomes bidirectional. AI systems require advanced semiconductors, while economic systems increasingly depend on AI-powered services. This creates potential for cascading failures where chip shortages disable AI systems that themselves have become essential infrastructure. The financial impacts would extend beyond direct manufacturing disruption. Semiconductor companies represent significant portions of major stock indices. Disruption affecting these firms would impact investment portfolios and pension funds globally. The banking sector would experience additional pressure as loan portfolios containing affected manufacturers faced potential defaults. As AI accelerates its integration throughout the economy, these physical supply chain vulnerabilities create an additional layer of risk beyond the workforce and structural changes we've examined. Beyond these physical supply chains, AI creates new vulnerabilities in our financial systems as well. Pension systems, already strained by demographic changes, face additional pressure as technological displacement accelerates. The pension system collapse. Could AI be the final stress that breaks already strained retirement systems? Pension programs across Europe face mounting pressure from demographic shifts, but technological disruption might accelerate these challenges beyond the breaking point. The European Commission's 2024 Aging Report presents a concerning outlook for retirement systems across the continent. By 2070, pension spending will increase significantly in 16 EU member states plus Norway. These increases represent substantial fiscal challenges that will reshape government budgets and economic priorities for decades. Luxembourg faces a projected 8 percentage point increase in pension spending as a percentage of GDP, equivalent to the entire defense budget of most European nations. This dramatic growth forces painful choices: reduce other government functions or implement substantial tax increases. The core problem is demographic. Europe's population is aging while birth rates remain below replacement level. Germany's old age dependency ratio will rise from 36 pensioners per 100 working age adults today to 55 per 100 by 2070. Spain's situation is even more dramatic, increasing from 31 per 100 to 72 per 100. These shifts fundamentally challenge pension systems designed around more favorable demographic profiles. For 72-year-old Maria in Barcelona, these statistics translate to real anxiety. After contributing to Spain's system for 45 years, she now watches as her monthly benefit gradually loses purchasing power against inflation. We planned carefully for retirement, she explains, but no one planned for this uncertainty. European pension programs operate primarily on a pay-as-you-go basis, with current workers funding current retirees. This model works with a large workforce supporting a small retired population. As this ratio inverts, the financial mechanics break down. Workers must pay higher contributions, or retirees must accept reduced benefits. AI-driven job displacement accelerates these pressures dramatically. Pension systems face fewer contributors as jobs disappear, while simultaneously supporting more people who retire early due to technological unemployment. This creates a financial acceleration effect that brings pension challenges forward by decades. When AI eliminates positions in financial services, administrative support, or customer service, those workers no longer contribute through payroll taxes. European pension programs typically collect between 18 to 25% of wages for retirement funding. Each eliminated job represents thousands of euros annually disappearing from pension systems, a substantial impact when multiplied across millions of positions. The Commission's projections account for gradual technological change, but don't fully incorporate scenarios where AI rapidly displaces 15 to 25% of jobs within a decade. Current models assume technological displacement occurs gradually enough for workers to transition to new roles. If AI creates faster displacement with longer transition periods, the financial pressure intensifies dramatically. Some nations have implemented reforms aimed at controlling costs. Greece, Italy, and Portugal project decreased pension expenditure as a percentage of GDP by 2070. These projections rely on politically difficult benefit reductions and raised retirement ages. Greece has raised the effective retirement age while reducing benefit calculations. Portugal has frozen pension indexation during economic downturns and implemented sustainability factors that automatically adjust benefits based on demographic changes. These reforms raise questions about social cohesion and intergenerational equity. Decreased benefits or increased retirement ages create potential for social instability when citizens find their retirement expectations unmet. Eastern European countries face both demographic decline and technological vulnerability. Poland's population will shrink by 13% by 2070, while its old age dependency ratio nearly doubles. If AI simultaneously displaces workers in business services and manufacturing, the country could face pension funding shortfalls decades earlier than projected. The stability implications extend beyond government budgets. Pension funds, controlling approximately 4 trillion euros in assets, are among Europe's largest institutional investors. Funding shortfalls forcing liquidation of positions could create substantial market pressure affecting broader financial markets. European banks maintain significant exposure to pension systems through lending and asset management services. Banking system stability connects directly to pension system health. Greece's debt crisis in 2010 to 2015 stemmed partially from unsustainable pension obligations that drove sovereign borrowing beyond sustainable levels, creating financial contagion throughout southern Europe. The AI pension relationship is particularly concerning due to timing alignment. Most analyses suggest maximum job displacement will occur between 2025 to 2035, precisely when demographic pressures intensify naturally, creating compounding rather than sequential challenges. Private pension savings face their own vulnerabilities. If AI-driven displacement creates economic contraction, investment returns could fall below projections needed to fund retirement obligations, affecting individual retirement security across wealth levels. When pension systems fail in aging populations, the resulting instability creates cascading effects: increased government borrowing costs, contracted consumer spending, and increased precautionary saving. These effects can transform pension system stress into general economic contraction. Some suggest AI productivity gains could address pension challenges by increasing output per worker. This outcome requires broad distribution of productivity benefits and successful worker transitions to complementary roles. Without careful policy design, productivity gains may concentrate among capital owners rather than translating into higher wages supporting pension funding. Pension system vulnerability represents a hidden economic threat that receives insufficient attention in AI impact assessments. While job displacement discussions focus on immediate employment effects, the secondary impacts through retirement systems could create more significant macroeconomic risks, potentially triggering broader economic contraction beyond direct employment effects. Currency depreciation cascade. How could AI-triggered economic instability create a currency crisis in emerging economies? While much attention focuses on technological disruption in advanced economies, developing nations may actually face greater vulnerability through financial channels rather than direct job displacement. According to the United Nations Conference on Trade and Development, UNCTAD, developing countries are projected to bear the brunt of economic challenges in the coming years. Their economic outlook forecasts growth in developing economies slowing more severely than in advanced economies, with particular vulnerability in countries dependent on commodity exports or foreign financing. This vulnerability creates fertile ground where technological disruption could trigger financial instability through currency markets. AI adoption follows capital. Countries with strong technology infrastructure, established research capabilities, and supportive regulatory environments demonstrate faster AI implementation. These technology centers, primarily clustered in North America, East Asia, and Western Europe, attract investments seeking exposure to AI-driven productivity gains. As capital flows increasingly target these regions, vulnerable economies face potential outflows that destabilize their currencies. The mechanism works through investor perception and capital allocation decisions. As AI demonstrates tangible productivity improvements in advanced economies, investment capital naturally gravitates toward markets expected to benefit from these technologies. This creates potential for accelerated capital flight from economies perceived as technological laggards. Emerging economies could face currency depreciation through several connected pathways. Portfolio investments might shift from developing markets toward technology-focused markets. Direct investment could favor regions with established AI ecosystems. Domestic investors in emerging economies might seek to diversify toward markets with greater AI exposure, creating additional outward pressure. When capital leaves an economy faster than it enters, currency values typically decline. This depreciation is like a crack in a dam, small at first, but quickly widening as pressure builds. The initial currency weakness triggers a cascade of effects. Import costs rise, creating inflation. Companies with foreign-denominated debt face increased repayment burdens. Government borrowing costs increase as currency risk grows. What happens to everyday families when their savings lose value overnight? Basic necessities become unaffordable, education plans derail, and retirement security evaporates. The Turkish currency crisis of 2018 illustrates this dynamic. The lira lost approximately 30% of its value against major currencies within months. Inflation exceeded 25%, and economic growth contracted sharply. Behind these statistics were millions of Turkish citizens watching their purchasing power collapse, businesses unable to service foreign loans, and essential imports becoming prohibitively expensive. AI could create new forms of economic inequality between technology-leading and technology-following nations beyond simple productivity differences. Technology-leading nations develop AI capabilities that enhance their economic competitiveness. Productivity improvements, new product development, resource optimization, and enhanced services. These capabilities could widen existing economic disparities by accelerating growth in advanced economies while technology-following nations struggle. This divergence appears particularly concerning for middle-income economies with manufacturing or service sectors vulnerable to AI disruption. Countries like Malaysia, Thailand, Brazil, and Turkey have built economic development around integration into global supply chains and service exports. As AI enables reshoring of manufacturing and automation of services previously outsourced to lower-cost regions, these economies face competitive disadvantages precisely when they need increased investment to develop their own AI capabilities. The developmental timeline creates additional challenges. Establishing domestic AI capabilities requires advanced digital infrastructure, specialized education, and supportive regulations, foundations that take years or decades to build. Economies that fall behind in AI development may struggle to catch up as technology-leading nations continue advancing. Projections show concerning patterns for developing economies. The World Bank estimates that sub-Saharan African countries could see negative spillover effects from AI adoption, exceeding direct benefits for at least the next decade. Latin American economies with significant service exports could experience trade balance deterioration as services become automated in advanced economies. Southeast Asian manufacturing hubs face potential competitive challenges as automation reduces labor cost advantages. Currency markets often reflect these economic projections through anticipatory movements. Markets price currencies based on expectations rather than current conditions alone. This creates potential for currency movements to accelerate based on perceived AI readiness rather than waiting for actual economic impacts. Currencies of economies considered AI laggards might face pressure even before measurable economic effects occur. Some developing economies recognize these risks and have implemented strategies to mitigate potential currency instability. Countries including Rwanda, Vietnam, and Costa Rica have created AI development strategies that include infrastructure investment, education initiatives, and regulatory frameworks to attract technology investment. These early movers seek to position themselves as AI-ready economies that can attract rather than lose capital during technological transition. The potential for currency instability to trigger broader financial contagion creates systemic risks beyond individual economies. Modern financial markets maintain significant interconnections through banking relationships, investment flows, and trading patterns. Currency crises rarely remain contained within national borders. Global debt levels create additional vulnerability. Many developing economies maintain significant external debt denominated in foreign currencies. When local currencies depreciate against the dollar, this debt becomes more expensive to service. According to the IMF, over 60% of low-income countries now face high risk of debt distress, creating pre-existing vulnerability that currency depreciation could transform into default. Developing economies may therefore be more vulnerable to AI disruption than developed ones due to capital flight and currency instability. While advanced economies face significant challenges managing workplace transitions, they benefit from stronger financial foundations and greater resources for adaptation. Developing economies face the combined challenge of managing technological transition with limited resources while simultaneously protecting financial stability. This financial instability connects directly to central banks tasked with maintaining economic stability. These institutions would face unprecedented challenges responding to AI-triggered disruption, particularly in developing economies. The central monetary policy tools. What happens when central banks face an economic crisis unlike any they've seen before? The institutions responsible for monetary stability worldwide operate using frameworks developed for traditional economic cycles. Their tools and models assume certain relationships between employment, inflation, growth, and interest rates. But artificial intelligence threatens to disrupt these fundamental economic relationships, potentially rendering conventional monetary policy ineffective during an AI-triggered downturn. The International Monetary Fund's July 2024 World Economic Outlook highlights a troubling reality. Services inflation remains persistent across major economies, complicating the normalization of monetary policy. Central banks have maintained higher interest rates to combat inflation, but these elevated rates create vulnerability in economies already struggling with slowing growth. The IMF notes that this combination, stubborn inflation alongside decelerating growth, creates particular challenges for monetary authorities attempting to balance price stability with economic expansion. This balancing act becomes exponentially more difficult with AI. Artificial intelligence creates a paradoxical economic effect by generating both deflationary and inflationary pressures through different channels. On the deflationary side, AI drives significant productivity improvements. As companies implement AI systems that increase output per worker, they can produce more goods and services with fewer inputs. This productivity growth typically exerts downward pressure on prices as production costs decrease relative to output. The European Central Bank estimates that widespread AI implementation could increase productivity growth by 0.8 to 1.4 percentage points annually across developed economies. This productivity acceleration would normally allow central banks to maintain lower interest rates without triggering inflation. However, these same technologies create substantial economic disruption that can produce offsetting inflationary pressures. When AI displaces workers in specific sectors, it creates transitional unemployment that can reduce overall economic output, while those workers seek new positions. This transitional period often features both higher unemployment and higher prices in certain sectors, resembling stagflation more than typical recessionary conditions. Companies implementing AI systems also typically make substantial upfront investments in hardware, software, and reorganization. These investment surges can create demand-pull inflation in technology sectors, even as other areas experience deflationary pressure. Current central bank interest rates reveal the precarious starting position. The Federal Reserve's benchmark rate stands near 5.33%, compared to essentially zero before the pandemic. The European Central Bank maintains rates at 4.25%, up from negative territory pre-pandemic. The Bank of England holds at 5.25%, while the Bank of Japan has finally moved away from negative rates to 0.25%. These elevated rates leave limited room for traditional stimulus if an AI-triggered recession emerges. Unlike previous technology-driven economic disruptions, AI threatens to compress transition timelines dramatically. AlphaGo defeated the world champion Go player in 2016. Just 7 years later, generative AI systems demonstrate capabilities across language, image generation, and reasoning that were considered decades away. This accelerating pace means economic relationships could shift faster than central bank models can adapt, like trying to steer a ship through foggy waters with outdated navigation charts. The typical transmission mechanism for monetary policy requires months or years to fully impact economic activity. When central banks adjust interest rates, the effects gradually ripple through the economy. This mechanism assumes relatively stable structural relationships. If AI rapidly transforms these relationships while policy works through the system, central banks could find themselves responding to economic conditions that no longer exist by the time their policies take effect. Consider this scenario. An AI-triggered recession begins with significant job displacement in service sectors. Central banks respond by cutting interest rates to stimulate demand. However, during the 12 to 18 months required for these rate cuts to fully impact the economy, AI implementation continues advancing. By the time the monetary stimulus fully transmits, the structural relationships it was designed to influence have transformed. The stimulus might prove either inadequate or misdirected. This acceleration creates pronounced risk that central banks could find themselves fighting the wrong economic battle. The tools themselves may prove inadequate for addressing an AI-triggered downturn. Interest rate adjustments primarily influence aggregate demand through borrowing costs and wealth effects, but have limited direct impact on the structural changes AI creates. Quantitative easing influences financial conditions, but similarly lacks precision for addressing specific sectoral disruptions. The geographical aspect adds further complications. AI implementation will likely progress at different rates across countries and regions, creating divergent economic conditions within currency unions or trade blocs. The European Central Bank already struggles with policy appropriate for both Germany and Greece. These challenges would intensify if AI adoption occurs unevenly across member states. The 2021 Federal Reserve situation offers a sobering case study. When post-pandemic inflation surged, the Fed maintained that price increases were transitory, guided by models that failed to account for unprecedented supply chain disruptions and stimulus effects. This error allowed inflation to accelerate, eventually requiring more aggressive rate hikes that caused greater economic pain than an earlier, measured response might have produced. An AI-triggered economic shift could create similar model failures with even more complex consequences. Some central banks have begun examining these challenges. The Bank of England has created a dedicated AI economic analysis unit. The Federal Reserve has commissioned research on AI's potential impact on labor markets and inflation dynamics. The European Central Bank has incorporated limited AI scenarios into their forward economic projections. However, these efforts remain preliminary rather than operational. The most concerning aspect is the potential for policy errors during an unprecedented transition. When policymakers lack appropriate models for understanding economic changes, they risk implementing measures that exacerbate rather than alleviate problems. Beyond economic policy considerations, previous technological revolutions provide important lessons about adaptation, transition periods, and eventual outcomes, even if their timelines differed from what we now face with artificial intelligence. Historical precedents. Has technology ever triggered economic collapse before? And what can it teach us about AI's potential impact? Throughout history, major technological transitions have created significant economic disruption alongside their eventual benefits. These historical examples provide valuable context for understanding AI's potential economic impact, though important differences exist in both scale and speed. The mechanization of agriculture represents one of the most profound technological transformations in economic history. In 1800, approximately 83% of the American workforce engaged in agricultural production, but by 2000, this figure had shrunk to just 2%. This massive workforce shift occurred as innovations from McCormick's reaper to modern combine harvesters dramatically increased productivity. A single farmer today produces over 12 times the output of their 1950 counterpart. This transformation created substantial human costs. Rural communities experienced population declines as workers migrated to urban centers seeking manufacturing jobs. Rural banks faced waves of failures when farmers couldn't service debt acquired for increasingly expensive equipment. The broader economic impact culminated in the farm crisis of the 1920s to 1930s, when mechanization combined with overproduction created price collapses that contributed significantly to the Great Depression. Agricultural employment declined by over 5 million jobs between 1910 and 1950, while ultimately creating a more productive food system. This shift generated decades of hardship for those caught in the transition, a pattern that raises concerns about AI's potential disruption. The Industrial Revolution similarly transformed production from artisanal workshops to factories, eliminating entire categories of craftwork. skilled weavers in England who had earned comfortable middle-class incomes found themselves displaced by power looms. The Luddite movement emerged directly from this economic displacement as workers destroyed factory equipment in protest. During this period, the British economy experienced 7 recessions between 1830 and 1885, with GDP contractions averaging 7% during downturns. Income inequality increased substantially as factory owners accumulated unprecedented wealth, while displaced workers faced wage compression. More recently, manufacturing automation created economic dislocations across the American Midwest. Cities like Detroit, Cleveland, and Pittsburgh lost between 30 to 45% of their manufacturing jobs between 1980 and 2000, creating lasting economic scars with elevated unemployment in some communities for decades. Each of these historical shifts offers important lessons about how technological change can create both progress and painful transitions, patterns we must understand as AI transforms our economy. The pace of adoption marks a critical difference between past technological innovations and AI today. The transition from horse-drawn plows to tractors took approximately 50 years to reach 80% adoption. Electricity required nearly 40 years to spread to 80% of American factories. In contrast, ChatGPT reached 100 million users within 2 months of its release. Enterprise AI implementation is similarly accelerating, with 55% of companies implementing AI in at least one business function by 2023, up from just 20% in 2018. This compressed timeline gives economic systems far less time to adjust through normal market mechanisms. Past technological shifts created temporary economic dislocations before new equilibriums emerged. During these transitions, displaced workers eventually found employment in newly created sectors. Agricultural workers moved to manufacturing. Manufacturing workers transitioned to services. Each shift required time, often a generation or more, but employment markets eventually reached new balances with comparable or greater overall employment. Historical transitions benefited from economic factors that differ in the AI context. Previous revolutions primarily affected physical production, creating, moving, or transforming goods, impacting specific workforce segments. AI differs by potentially affecting a broader range of economic activities simultaneously. It can generate creative content, perform analytical tasks, make complex decisions, interact with customers, and coordinate operations, functions previously requiring human cognition across multiple sectors. This breadth means disruption could occur across more occupational categories simultaneously rather than sequentially. Educational requirements present another key difference. When agricultural workers transitioned to manufacturing, new factory jobs often required limited formal education. Someone with basic literacy could learn necessary skills through on-the-job training. The transitions potentially created by AI would likely require substantial formal education or retraining, creating steeper barriers for workforce adaptation. Demographic factors further complicate the comparison. Previous technological revolutions occurred during periods of population growth, creating expanding domestic markets and new labor force entrants who could train directly for emerging occupations. Today's AI revolution coincides with slowing population growth across many developed economies, reducing similar natural adjustment mechanisms. This raises legitimate questions about whether our economic systems can adapt quickly enough to this accelerated pace of change. Historical transitions, despite causing significant hardship, ultimately resolved through market mechanisms operating over decades. When technological change compresses into years rather than decades, these adjustment mechanisms face unprecedented pressure. The historical record suggests technology-driven economic disruptions have ultimately yielded new economic equilibriums with higher productivity and living standards. However, AI's unprecedented scope and pace mean we cannot simply assume historical patterns will repeat. The question isn't whether humanity can eventually adapt to AI-integrated economies. History suggests we can, but whether the transition period might create economic dislocations severe enough to trigger systemic crises before new equilibriums emerge. If these risks are real, what can be done to prevent economic collapse while still capturing the tremendous potential benefits of artificial intelligence? Prevention strategies. What could actually prevent an AI-triggered economic collapse? While the risks we've examined are substantial, they're not inevitable. Effective prevention requires coordinated action across multiple domains, from government policy to education systems to business practices. These interventions need to work together to manage the transition while maximizing AI's benefits. The challenge isn't whether solutions exist, but whether they can be implemented quickly enough. AI capabilities continue advancing rapidly, with each new model generation demonstrating significant improvements over previous versions. The window for establishing effective guardrails narrows as commercial implementation accelerates. Many large companies have already begun substantial AI integration, creating urgency for adaptation strategies before displacement reaches critical levels. Universal basic income provides all citizens with a regular stipend regardless of employment status, creating a financial floor through economic transitions while maintaining consumer spending. Finland's experiment showed modest improvements in recipient well-being but limited employment effects. Full implementation would require significant fiscal resources, approximately 20 to 25% of GDP in most European countries. Current educational systems need substantial reimagining for an AI-integrated economy. Singapore's Skills Future program provides citizens with credits for continuing education throughout their working lives with specific AI-focused training paths. Denmark invests heavily in flexicurity, combining flexible labor markets with robust retraining programs and income support during transitions. Their adult participation in continuing education reaches 29%, nearly triple the European average. The European Union's AI Act establishes the first comprehensive regulatory system, classifying applications by risk level with requirements proportional to potential harm. Some countries have begun exploring algorithmic impact assessments that evaluate potential workforce effects before large-scale implementation. These regulatory frameworks work alongside tax system modifications that distribute AI benefits broadly. South Korea has reduced tax deductions for companies implementing automation without creating offsetting employment, effectively disincentivizing job-eliminating technology without prohibiting innovation. International coordination proves essential for managing AI's economic impacts. Without aligned approaches, companies can relocate implementation to regions with fewer restrictions. The OECD AI principles establish shared commitments across 42 countries, though these remain voluntary and lack specific enforcement mechanisms. Several countries have implemented comprehensive policies addressing multiple aspects of AI transition. Canada's AI strategy combines research funding with labor market impact analysis. Their Skills for Success program specifically addresses capabilities needed for an AI-transformed workplace, including adaptive thinking and technological literacy. A participant in the program, Marie LaFontaine, saw her manufacturing job automated but transitioned to a technical oversight role. The program didn't just teach me new skills. It showed me how my experience could be valuable in ways I never imagined. South Korea's Digital New Deal allocates $49 billion for AI infrastructure development while simultaneously funding extensive retraining programs for industries facing disruption. This coordinated approach recognizes that standalone interventions rarely succeed. Countries combining strong safety nets with active labor market policies have historically managed technological transitions more successfully than those relying on market adjustments alone. Evidence from historical interventions provides guidance. Cash transfer programs demonstrate positive impacts during economic transitions, but require sustainable funding mechanisms. Educational approaches work best when designed around flexibility rather than specific job training. Programs teaching adaptable skills appear more effective for long-term employment security than narrow technical training. Business models themselves must evolve. Human-in-the-loop AI implementation augments rather than replaces workers. A European insurance company deployed AI systems for routine claims processing while elevating human agents to complex case management roles. This increased productivity by 27% while maintaining overall employment. As claims processor Marco Rossi described, "The AI handles the repetitive parts one used to dread. I now focus on helping customers with complicated situations where my experience makes a real difference." Worker ownership structures, profit-sharing programs, and labor representation in AI implementation decisions can similarly improve benefit distribution. Companies that view AI as a complement to human work rather than a replacement often develop more sustainable business models with broader stakeholder benefits. The time pressure creates genuine concern. Traditional policy cycles require years, while AI capabilities advance much faster. Regulatory systems designed for gradual change struggle with technologies that improve exponentially. Business decision cycles operate on quarterly timeframes, creating incentives for short-term cost reduction rather than longer-term workforce transformation. Can these strategies actually prevent collapse? Historical perspective offers cautious optimism. Previous technological transitions ultimately resolved into more productive economies, but typically occurred over generations rather than years. Managing AI's economic impacts on a compressed timeline represents an unprecedented governance challenge. The choices made now will determine AI's economic impact. The technology itself remains neutral, capable of either eliminating jobs without creating alternatives or augmenting human capabilities while generating new value. The determining factor isn't the technology, but implementation, regulation, and benefit distribution. Prevention strategies require balancing innovation with stability. Policies that slow adoption enough for adaptation without preventing beneficial development represent the narrow path forward. Countries successfully navigating this balance will likely emerge as economic leaders in the AI era, while those that either resist change entirely or allow unmanaged. Disruption may face prolonged instability. AI now stands at a decisive moment in economic history. The analysis we've examined reveals real vulnerabilities that could trigger continental or even global economic contraction, from pension systems to semiconductor supply chains to currency stability. These domino effects are mathematical projections based on current trends combined with accelerating technological implementation. Collapse remains avoidable. Prevention strategies, education reform, monetary policy adjustments, and new social support systems offer pathways through this transition, requiring unprecedented cooperation and speed. The AI transformation of our economy is certain. Our challenge is whether we can adapt our systems quickly enough to harness benefits while preventing a single falling domino from reshaping continents.